Business owners often have a real awakening at the closing table. And I assure you, closing table is not the time to start finding out your tax consequences, especially significant ones, and especially if you've already signed some kind of binding document selling your business. So let's talk about the main considerations. First thing you need to worry about is what type of entity you are, if you're a C Corp versus an S Corp. 70% of all market transactions are asset sales. Buyers want to buy your assets, not your stock. Why? Buyers like asset sales because it gives them tax advantages and they can pick and choose which liabilities they will assume and disregard the rest. So it's because of that asset sales are quite prevalent. If you're a C Corp and selling and the buyer wants an asset sale, which is at least 70% of the time, you could be subject to double taxation. You will pay tax at the corporate level and then you pay tax at the personal level, and you'll pay, in some states, pay your state tax on top of that, which could put you in a very, very significant tax situation. If you're an S Corp, an asset sale should be a tax neutral effect. The only time this could be an issue for you is if you've got significantly depreciated assets, creating some kind of a depreciation recapture issue at ordinary income tax for you. So other thing that you need to look at is, could you potentially do a tax-free exchange? In a tax-free exchange, your C Corp or S Corp would exchange its stock for the stock of the acquirer. In this case, you would potentially defer taxation altogether. Another thing to keep in mind is escrows. A lot of buyers, to minimize their risk, demand that 5 to 20% of the purchase price be put in an escrow account, and this escrow account would essentially minimize their risks against misrepresentations and also for working capital adjustments and etc. You could structure the escrow in a way that you don't have to pay taxes until you actually receive the money. Other thing that you need to really look at is that if you are subject to state income taxes. Many states require you to pay state income taxes on the sale of a business. So you need to really look at which state you live in and what the consequences to you specifically would be. My advice, as I said earlier, don't do tax planning at the closing table, especially after you've signed some binding agreement. Understand what your tax consequences are so you can posture and optimize your situation to maximize your sale value and minimize the tax bite. Rare Brain Capital helps companies improve performance and sell for maximum value. How ready is your company to grow or to sell? Want to know how you're doing? Get your free score plus customized report in just a few minutes at no cost or obligation. Visit rarebrain.com/score.